Hello and welcome back to our InvestEd vidcast series. I'm Chris Sabula and I'm here today with Mark Armbruster. We're here to discuss a topic that, as advisors, we hear about all the time, the idea that we should be investing for dividends, yield, and income.
That topic does come up a lot, and I know it's blasphemous to admit, but I hate dividends.
Okay, that's a pretty strong statement. Why?
The bottom line is that investing for income generally involves taking on more risk than necessary, and almost by definition results in higher taxes than necessary. There are far better ways to get investors the money they need from their portfolios than by generating a lot of income from dividends and bonds.
That seems reasonable enough, but what about the idea that if I can earn 4% between dividends and interest, and I take 4% out of my portfolio to fund my lifestyle, my portfolio and life are in perfect harmony, zen?
I recognize that's a very nicely packaged concept, but the math doesn't really work out. There are three approaches to getting money from your portfolio. You can generate income through dividends and bond interest, the high income approach that we're discussing. You can realize capital gains by selling stocks or other investments that have gone up in value, or you can draw principal.
So which is the best approach to getting your money to live on? Maybe you can walk us through an example. Assume you have a $3 million investment portfolio and then you need to draw $120,000 a year out, or 4% of the portfolio to meet your living expenses. Also assume the money is held in a taxable brokerage account so that taxes are of consequence.
Okay, so let's say there are three investors with these exact same circumstances, and each uses one of the different approaches to get that money. Investor 1 generates her $120,000 in income exclusively through dividends and bond interest. Investor 2 sells stocks and realizes capital gains to get the $120,000 he needs. And Investor 3 gets the money by drawing on principal. Perfect. So Investor 1 has to pay tax on all the dividends and interest she earns. Some of this will probably be taxed at the favorable qualified dividend tax rate, but likely much of it will be taxed as ordinary income. So a 30% blended tax rate is probably a reasonable assumption, and that would result in a spendable income of $84,000. She draws out $120,000, she gets to spend $84,000. Investor 2 will have to pay capital gains tax on a portion of the sales that he makes to generate his $120,000. If we assume half of the proceeds are taxable and taxed at the long-term capital gains tax rate, the net spendable amount here would be $108,000. Investor 3 draws money out of principal, which of course is not taxed, and therefore he nets $120,000. So in this scenario, generating a lot of income just results in a huge tax friction that could be completely avoided.
Fair enough, but are those assumptions, with everything else being held constant, really reasonable?
No, not really. You likely can't generate a 4% return only from dividends today, given the interest rate environment that we're in. And you probably couldn't draw only principal from a portfolio unless you're sitting on a lot of cash, which would hurt long-term returns. But it makes the point that you should expect to pay more taxes with a high-income approach. It's absolutely true and unavoidable unless you're investing only in retirement accounts.
You mentioned that investing for income is generally riskier than more traditional approaches. Why is that? Aren't dividend-producing stocks usually in lower-risk segments of the economy?
Yes, they can be, but in order to generate 4% in dividends and bond income in our current low interest rate environment, you'd have to structure the portfolio in a very risky manner. For example, safer bonds, such as treasuries, are yielding less than 1% in many cases. So to get bonds that have a 4% yield to maturity, you'd have to buy riskier bonds, probably even junk bonds, or bonds with a very long duration.
But what about high dividend stocks? The classic, it's got a great yield that we always hear about.
With stocks, you would likely have to concentrate your portfolio in the industries that pay the highest dividends, which reduces your overall portfolio diversification and results in higher risk. And the problem with buying riskier investments is that when the stock market declines, they tend to lose more money than more traditional type of investment approaches.
But the income-loving investors would counter that it doesn't matter as long as you continue to get your dividends.
That's true, but dividends often get cut during nasty market downturns. It happened in 2008, and it happened again just recently. In fact, Dow Jones recently announced that expected dividends for 2020 are going to be down by $42 billion as a result of companies reducing or suspending their dividends. During bad times, companies need to conserve cash, and whacking the dividend is an easy way to reduce cash outflow. That means that your income could be reduced when your portfolio value is at its most depressed. If you need cash at that time, there are few options except to sell stocks at low prices, which could result in realizing permanent losses.
But don't investors earn higher returns with dividend-paying stocks? Maybe the excess returns are enough to offset the taxes and short-term risk.
Historically, dividend-paying stocks have outperformed the overall stock market, but probably that has nothing to do with the fact that they pay dividends. Rather, it's probably because high dividend-paying stocks tend to also be value stocks. And over long periods of time, value stocks have outperformed. Pure value stocks have done even better than dividend-paying stocks. There's also some academic basis for this. There was a paper written in 1961 by Professors Miller and Modigliani. They showed that a company's dividend payout policy doesn't have an effect on the current price of its shares, nor on the total return realized by shareholders. So dividends, in effect, are irrelevant to investors' returns.
I guess that makes sense because all else equal, a stock drops by the amount of the dividend when that stock goes ex-dividend. So a $100 stock that doesn't pay a dividend is obviously worth $100. A $100 stock that pays a $5 dividend becomes worth $95, but the investor still has $100. $5 of it just happens to be now in cash.
Right. Miller and Modigliani were effectively the forefathers of total return investing, which is still generally the accepted approach today.
And by total return, you mean striving for the best return possible and being agnostic between income and capital appreciation?
Yes, even though I would still argue that capital appreciation is better from a tax perspective when you have the ability to choose that.
So what's the solution? Should we all look for stocks that don't pay dividends, like technology companies?
Well, the first thing investors have to do is to change their understanding and their mindset around income investing. Instead of maximizing income, they should think about how best to grow their assets and then how to access those assets most efficiently when they need them. Dividends and bond income can't always be avoided, and they probably shouldn't aggressively be avoided, but neither should you build a portfolio that emphasizes a high-income approach.
So in summary, in today's ultra-low interest rate environment, it's tempting for investors to take additional risk to generate the income they need from their portfolios. While that may seem like a rational response to today's economic realities, there are too many pitfalls with this approach, and focusing on a diversified, balanced portfolio is probably more prudent. Give us a call if you'd like to talk in more detail about investing for income or any other investment-related topic. Thank you again for joining us today, and we look forward to having you tune in to future ACM InvestEd episodes.